Last week was our first playoff game, and my plaque psoriasis was so itchy under all my gear. Sometimes just thinking about scratching could take me out of the moment. And then my doctor told me I could get clearer skin with a pill called Otezla.
Otezla apremilast is a prescription medicine used to treat adult patients with plaque psoriasis for whom phototherapy or systemic therapy is appropriate. Otezla can help you get clearer skin after just 4 months.
Okay, ready for the next game. Talking to my doctor about a pill was a total game changer.
Don't use Otezla if you're allergic to it. Get medical help right away if you have trouble breathing or swallowing, swelling of the face, lips, tongue, throat, or arms. Severe diarrhea, nausea or vomiting, depression, suicidal thoughts, or weight loss can happen. Tell your doctor if any of these occur and if you have a history of depression or suicidal thoughts. Live in the moment. Ask your doctor about Otezla. Call 1-844-4-OTEZLA or visit Otezla.com for prescribing info about cost, and more.
Reality radio for a really great future. We're talking real money.
Has it been a week already? Already a week?
Shockingly,
Wait a minute.
yes.
Wasn't I just here? You know, I decided, I just realized that I never leave. I'm always in this studio.
You are. I mean, that I can attest to, because every time I'm
always in
get you on the blower, there you sit. So.
Yeah. I just get, it's like the mic is now a part of me.
It's a solitary existence, but
it is. It's a lonely existence. But somebody has to do this. Hello, everyone. I'm Don. That's Tom. And this is Talking Real Money, the program devoted to talking about money realistically and really and real investing. So if you have a question about investing or managing your money, or you want a second opinion, hey, why don't you give us a call at 855-935-TALK, 855-935-8255. Not only can you call us live during the show, and if you call us live during the show, we have a bribe for you. Wait. It's still summer, right?
Indeed it is, sir.
Because I never leave the studio. Can you stick your arm outside the studio? Just make sure it's still summer out there.
Well, I stuck it out this morning, and I got raindrops on it. Shocking.
Wait a minute.
Shocking.
I thought it was like going to be a billion degrees outside or something.
I think it's going to be like 85 degrees later, but I did get rained on earlier today. So
both Seattle and Great Britain are melting under the heat.
That's true.
Because it's summer, we bribe you. We're not above bribing you to call the show and make it more fun for all of us. And the bribe this weekend is an exciting one. It is a full 2 years of the only magazine devoted to nothing but real investing. No speculation, no business news, no lifestyle stuff. Thus the name, Real Investing Journal. 2 years are yours free for being a part of the show. But you have to actually participate. That means pick up the phone, call in, be on the show live. 855-935-TALK, 855-935-8255.
And had you read the magazine for the last few years, you would not be concerned by this week's major financial headline, which was the decline and near fall of two very well-known technology companies.
It gave me something to talk about in my morning reports, though, on Thursday and Friday.
I'm sure it did.
Oh, it was great, because usually it's like, really, nothing's happening. Yeah. But I'll tell you what's happening, but it's nothing. On Thursday, it was like, oh, my gosh, did you see what Facebook did? It went down 20% in a day. Its chart looks like the Blue Cliffs of Dover. Only because MarketWatch, it's blue. It's like the straight line. Boom.
Yeah. And then Twitter had a problem on Friday.
And Friday,
right?
Yeah, Friday was a little birdie telling me that their stock went down. Get it? Twitter?
Yeah, I get it. Yeah.
Went down 20%. That's
sounds
kind of the magic. The magic number.
Well, and the reason that we bring this up is, as you know, again, if you're readers of the articles we write, if you listen to the show, et cetera, for all these years, we've told you, don't buy individual stocks. It's just too risky.
Oh, my gosh. And all the time, we get this response from people. What do you mean don't buy individual stocks? Everybody says buy individual stocks.
Yeah. You only buy the stocks that go up. You only buy the stocks at the companies where you shop, right? And that was the Motley Fool's thing. You go to Starbucks, so you buy their stock. No, individual equities, the academics are going to tell you the expected return of that stock. How much it should make is whatever group it's a part of. If it's a part of large U.S. companies, that's what you should anticipate the return. But the risk is off the charts because individual companies have bad days like they did this week. And sometimes they have really bad days. Like, didn't we used to have the largest trust bank in the world right here in Seattle? I think it was called Washington Mutual, something like that. That went away
I didn't trust them.
Yeah, exactly,
I didn't trust them.
Exactly.
So tell me about this trust business.
I like, in some ways, that this happens because it's a great reminder to you all that this is just, you think you know these companies well, right? Because you have a Facebook account or you read about it in the news, you do not know really what's going on day to day that could be really making your investment very, very, very risky.
What is powerfully illustrative about these declines, and remember both of these stocks went down about 20% in a day, is that when you're worrying about the stock market declining, you need to remember that only once in the entire history of the S&P 500, only one time has it ever declined by more than 20%.
That was
one time.
October 1987, correct?
October 1987.
Right.
The next largest decline was in 1929.
And we're proud to say neither of us could remember that one.
Yeah, and that was only 12%. If you had Facebook, you lost 20% of your money in a day. Not saying you're going to lose it forever, but this is scary stuff. 855-935-TALK is the number. We're going to talk about your money and your life.
Tom and Don are talking real money.
Your number one financial goal must be retirement. As we live longer, our need for a substantial retirement nest egg has grown. That's why you must have a plan. And to help you map your route to a brighter future, I created Vestory's Better Retirement Guidebook. And you can get a free PDF copy right now at retirebetterbook.com. It's truly free and there is no obligation. So get your Better Retirement Guidebook now at retirebetterbook.com. retirebetterbook.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Old people should not do the floss, whatever the heck that is.
Oh, you don't even know what it is. Wait a minute.
I saw it online this like yesterday, and I went, "What? Who came up with this stupid idea?"
I have a 10-year-old, as you know, and she, for the last few weeks, is trying to get me to do it. And I was like, I don't really care. And then I read the Wall Street Journal yesterday. It was in the Journal about how kids are trying to tell parents not to do it.
Well, right, because it's embarrassing.
So I can't do it.
It's like your parents necking in front of you or something. It's embarrassing.
I can't do it. My wife can do it. So, but
the
daughter.
Floss is kind of gross looking anyway. So I mean, it's like I'm not sure what they're doing, what they're flossing.
Exactly.
So,
all right,
and
letting it go.
Better not to go there.
Yeah.
But let's go to the phones. 855-935-TALK is our number. John, thanks for being bribed to be a part of the show.
Hey, John.
Hello. Thanks for having me. I appreciate your show. I've listened to a bunch of the podcasts, so I've learned quite a bit. I have a series of questions, but there's limited time. So I guess my question is helping me understand my stock allocation between now and then when I retire at 65, and just some of the things to think about on how best to look at that asset allocation.
How old are you now?
I'm 52.
52.
Okay. And what do you believe your stock to bond? In other words, how much of your money in the riskier things like stocks, how much in the less risky things like bonds or fixed income?
So right now, I think I'm one of the dinosaurs. I'm going to have about 3 different pensions. All of them are COLA adjusted.
Wow.
Hey, I wouldn't worry so much about my stock allocation. Then.
Right.
Make sure those companies stay healthy.
Does that make you a quadruple dipper?
Wow, because you're going to get Social
No,
Security?
just 3.
3 of them. 3. Well, no, in Social Security, that makes you a quadruple dipper. I don't know.
Right.
You are the first quadruple dipper I've ever met.
Yeah. Good
so,
for you.
well, a couple, it's with the state, and then a military reserve retirement, and then, of course, the Social Security. So my
okay.
my plan
So three
is
total.
those are the three. Okay.
Yeah, go ahead.
All right. So,
just-
what do you got?
I think the idea is to save money and assume some risk, but obviously I don't have to take too much risk. And the idea is to I think the thing that scares me the most is drawing around 5% for the first 4.5 years until I start getting my full retirement at 70.
So drawing in your mid-60s at a rather high rate,
right?
And then that would go down a bit because you'd be taking the Social Security at that point.
Exactly. And then my wife is...
Your wife? She works?
My wife's 6 years younger, and she works as well. And so then when she takes a full retirement, we'll be, like you said, pretty much close to our current income, which is
great.
my goal.
Yeah, well, and don't forget, by the way, when you're running the numbers, to include that nasty thing called inflation, which will make things more expensive in the next 13 years. There's a couple ways to look at this. Number one, oftentimes people tell us, well, I have these 2 pensions plus Social Security. Those are my bonds because those are stable and those are going to pay me and they're always going to be there. Then I take more risk with the other investments in stocks because I have this kind of fixed income, right? I struggle with that because more of this experience we know about says that people who end up taking more risk than they can emotionally end up selling at the wrong times. That's why we have, and this is our shameless plug, on the website talkingrealmoney.com, you can take the risk quiz.
Risk quiz, which is one word, risk quiz.
Risk quiz in about 15 minutes.
R-A-S-Q-U-I-Z, risk quiz.
That'll help you understand yourself around these decisions. It's a little bit about market knowledge. It's a little bit about how you feel about money. That might be one place to look. I struggle still, though, with somebody who's going to work another 13 years having anything more than 30 to 40% of their money in bonds.
Right. And
anything
right
more
now
than?
80,
oh, yeah,
20.
okay.
Yeah. I'm sorry?
80-20 stocks to bonds?
Right. Right now I'm 80 to 20 stocks to bonds.
Okay. Well, go find out what your risk tolerance is.
Well, I did take the quiz, and I'm in that risk tolerance group 4 today, anyway.
Okay, four is probably 4 probably means more like a 70-30, but hey, if you're comfortable, great. But here's the other thing that is important. You mentioned it. You actually said it. I don't want to take more risk than I need to.
Right.
That's also important. You have to remember that the market, this is the one thing we absolutely guarantee you. The market's going to go down. And when it goes down, you're not going to know it's going down. And when it goes down, it could go down a lot. And it scares the living daylights out of people, even those, because I've talked to people now for 30 years on the radio about this, and people who told me for years they could stay. When it actually happened, they panicked.
And that
so
leads to bad decisions. Yeah, I think that's good advice. So then in addition, you could either get a professional to run some sort of retirement calculation for you, or you could do it yourself. There's a lot of great online calculators as well. Now, what else did you have in your series of questions, John?
Well, that was sort of the risk adjustment. I guess my idea was to kind of split it into living expenses and non-living, sort of living expense type stuff, and then fun money and potentially legacy. And I think Tom had said something. He's doing something similar. Mm-hmm. So I guess the question is, how do you look at? So if you had 2 different pools, one you're going to draw from, one you may not draw from, you obviously would have a different asset allocation for that as well.
Well, yeah, the legacy part is going to be probably almost all stock. I mean, my Roth IRA is 100% in equities.
Okay.
I'm hoping to hit a home run, my kids and grandkids.
Now, and here's how I look at the necessities and the fun. I would let the market decide that for me. Because if you do take one of the strategies we propose, we are proponents of, and that is a flexible withdrawal strategy. You say, I'm going to take 5% of the value of my portfolio at the beginning of the year, for example. If you've had a good year previously, that 5% is going to be a lot of money. That's going to be a fun year. If it's been a bad year previously, that 5% isn't going to be as much money, but you'll probably still, with all your other stuff, make sure it's enough to cover your expenses, which it probably will be. That could be 4%, that could be 3%, whatever the number you're comfortable with. But make it a flexible strategy, which determines how much money you're going to have in that year to budget for fun.
A variable withdrawal strategy. Maybe one year, the good year, you take the gang to Hawaii. The next year, when you only it can only take out 2%, you take them to Wild
Smoky
Waves.
Lake Chelan.
No, Wild Waves.
Wild Waves. Oh, Wild Waves. That's a wild place.
Yeah, so something like
All
that.
right.
So that's my bad joke that sometimes works.
Yeah.
But the point, Lake Chelan. Thank you for your call. You're picking on Lake Chelan. I cannot believe you're doing that. That is outrageous.
Well, it's Smoky
That
Lake
was
Chelan
last
now.
year. It was once
It's
in like
this
100
year.
years.
There's a fire.
Oh, that's way over on the. There's no fire at the lake, and the lake is
It was
perfectly
just
clear.
in the news.
I just looked at the. For crying out loud. Okay, yeah, there's a fire within.
Are
like
you
30
telling
miles.
me?
You're okay?
30 miles.
It's east of the lake, and
It's
you know
second-
the prevailing winds kind of go
Secondhand smoke.
east or forget it.
Wait, don't the prevailing winds? Yeah.
Yeah,
All right, they
they-
go west to east.
Yeah, they do.
Yeah, you're right. They'll be okay. It'll be gone. Thought it was me, Smoky Lake Chelan. 855-935-TALK is our number. 855-935-8255. Give us a call. We'll talk about life and money.
Tom and Don are talking real money.
You know you need investing and financial advice to enjoy a better future, but you have no idea where to get it, right? The one thing you need most, you're probably missing, and that's a plan, because most of the financial services industry is concerned with making the next high commission sale instead of spending the time to understand your needs and fears. If you're looking for a 100% pure fiduciary, and we'll put that in writing, low-cost, fee-only advisor who puts you first, give Vestory a call at 800-386-3004. That's 800-386-3004, or visit us online at Vestory, VESTORY.com.
For your real life and real future, Tom and Don are talking real money.
855-935-TALK is the phone number you need to know to call the show to get answers to your financial questions, to learn about how to manage your dough and how to manage it better than you ever have before. See, I made that rhyme. Before? Dough? Bad rhyme. 855-935-TALK's the number. You can call that 24 hours a day, 7 days a week, too.
Have people been doing that? Have they been calling you late at night and waking you
you
up?
you haven't been listening to the podcast?
I have not. I have been doing other things.
Every week, in addition to turning these 2 hours into a podcast, I take some of your calls and the Como features that I do every week, and I condense them into what I call Talking Real Money Quick. It's
I was
about
kind
a
of wondering what that
15-minute
was.
podcast.
Okay. All right. I didn't know what
It's
that
a
was.
15-minute podcast where we answer questions, and I share these 60, 70-second tips on money.
Wow.
It's
Okay.
a great new podcast.
And so is that a different subscription kind of thing then?
No, it's all part of Talking Real Money. And with this is this is an important point for us to make. I want everybody to understand that while we're in business, the business of managing money, and we want to make money from that, and we make money, right? We've made a couple of bucks.
Some months, yes. Some months,
okay.
no. Yes, we make money.
We are not greedy. We give away a lot of stuff. We give away Real Investing Journal, even our real regular subscription to it's $25 for 2 years, which just covers printing and postage. But we give a lot of stuff away. You can download the Better Investing Guidebook. You can, and now I want to ask everybody a favor. Can I ask everybody a favor?
Well, I thought you were going through all the things we're giving away, but okay.
I am, because we're giving away something new.
All right, yes, please.
You guys know the book Financial Physics. It's huge.
Many people
huge, big.
been around
Thousands
for like
of those in
7 years or
circulation.
something now, yeah.
8 years. Do you know
Really?
I wrote that before Vestory was even a year old?
Wow, I did not know that.
In the summer of 2010, I wrote that.
Wow.
So what I've been doing over the past few months is I've been updating it to print a new edition, which I'll do in the next couple of weeks. But one of the things I always wanted to do was turn it. It lends itself to being an interactive book, and there's only one ebook platform that's interactive, and that's the iBooks format that Apple has. So what I did
Is this
was
on
I
my
created.
phone? Because I go look right now then.
Yeah, you can get it on your, go to iBooks on your phone. You can download it.
That means assumes I got to find iBooks on my phone.
It's
but
an orange icon that
Okay.
looks like an open book.
I see iTunes.
No, iBooks.
Okay.
iBooks.
Keep going because this may
But
be a
here's
while.
here's the deal. I put it up last week, and it's only been up there for about 2 days, and it's free. I decided to make it free. I'm not trying to make money off this. I want people to get educated. I really do. I want people to understand this. I don't want them reading books like this one, which is the #1 free book in the investing category at iBookstore. It's called Stock Trading, Tips for Trading Stocks. That's the #1 investing book. It's dangerous. The whole premise is dangerous. And but in just 2 days, Financial Physics is #2 in the free investing charts. I want it
just did
to
a search, though, and
#1.
It didn't come up.
Yeah. Did you go to the bookstore? You got to go to the store part.
I went to the place you told me to go to.
Yeah, but that's where your regular books are. There's a button here. Let me get my
wait a
phone
minute.
out.
All in series, move, delete. This is just, it's
It's
a
not
good
that
thing I
hard.
got
Why
kids,
do you think
'cause
this stuff is complicated?
Because I went to
It's
the
so
I went
funny.
to the place you told
All
me
right.
to go to.
See,
I typed
you
in
go-
financial physics and
No,
nothing
but
came
you went
up.
to the wrong. Okay, what you have to do is go to the bottom where it says search.
Okay, wait a minute. Wait a minute. Is it purchased or all in series?
Oh my gosh, financial. I'm doing it right now
Okay,
on my
search.
phone.
Okay, I'm doing it now too. Now
You
I'm
see
back
the
to-
little search thing?
Yeah, down at the bottom of the page.
Type it, financial physics.
By the way, you'll be glad to know that I did purchase 2 books this way. I didn't like either of the books though.
Well, this one you'll love.
I
You
know,
see, it
I
just
know.
it
Hang
it
on.
just came up. Look.
Okay,
look
wait.
at
It came up on the search. Wait. Oh, here it is. Oh, I could get it right now, and I will.
It's free.
Okay, and it's.
I'm telling you, and it's
down-
interactive.
Is this
it's
gonna be
fun.
like you gonna be like John Madden here, come blowing out of this thing or something? All right.
No, it's not that interactive.
okay,
but
I was wondering.
there are videos and there's a quiz. There are a couple of quizzes and
It
it's
says
fun.
done. I don't have to listen to you anymore. Just go read the book. So thanks.
Just
Have
go
a
read
good
the book
weekend.
from now on. That's it. 855-935-TALK, the number.
Are talking real money.
Just as there are basic laws that govern our physical world called physics with a PH, there are also basic rules and concepts that impact our finances and investments. I call them financial physics with an F. In fact, 8 years ago, I wrote a book about them. For years, I've wanted to create an interactive version of that book to help readers better understand the concepts. So, since it was time for an update, I turned financial physics, with an F, into a special interactive multimedia version only on iBooks. It's the only platform that allows that. Because I want everyone to have access to this information, I decided to give this version away. Yes, it's totally free. So if you have a compatible Apple device, go get your copy of the new interactive book, Financial Physics, on iBooks. It's totally free, and it's available right now in the iBooks store.
Reality radio for a really great future. We're talking real money.
855-935-TALK is our number, 855-935-8255. Have a question about managing, making, saving, spending, investing money? Give us a holler. And if you ask a question on this show, because it's our summer bribe season, we'll give you a free 2-year subscription to Real Investing Journal just for calling in, absolutely free, along with all kinds of other free stuff. Did you ever get the book to download?
Yeah, I'm reading.
on
This
iBooks?
guy is really smart. I'm reading the one about the stock picking thing. He is amazing. He has made.
Are you reading the stock
yeah,
trading
I
book?
mean, the picks
Yeah.
are just
Oh,
incredible.
Oh,
Really?
he did.
Now,
Just really.
he did not short apparently Facebook or Twitter this week, which is too bad. Okay, folks, I'm just kidding.
None of that was in there. But I wanted to mention something, though, because I want to be fair.
Yeah.
The iBook version is only for people with Apple products.
Yeah, I was going to ask you about that.
Which I decided wasn't completely fair to everyone else, but I couldn't make an interactive version for other platforms because they don't have that available. But I did turn it into a PDF. So if
Okay,
you
where
want to
do they
read
get
the
that? Where do
free
they get that?
PDF, you just go to talkingrealmoney.com to download the free PDF version. Or if you have an Apple product, it's more fun if you get the iBook version. Got it?
Yeah.
Did I cover
and
that?
the reason I was
All
picking
right.
on the stock picking guys because more numbers are out this year for how well stock pickers are doing. I know you hear all kinds of ads about how easy all this is to trade your way to big money every day. All kinds of.
I got another note from AAII today. telling me that if I'd used their system, I would have made 28,000% a year.
Yeah, and by the way, I think we figured this out last week.
Okay, maybe it was 2,800, but
we figured this out last week. If the claims were true of very many of these trading, they would have, we ran the numbers, like $100 trillion within a few years.
Ridiculous.
Yeah, I mean,
no, they would have the entire global GDP.
Yeah, so we'd be working
One
for
person.
them. One person. So, I mean, J.P. Morgan says, according to their data, only 41% of active fund managers, those are mutual funds where somebody's deciding whether to own Facebook or Twitter, are beating their benchmark.
In either case, it didn't work out.
It wasn't a good week.
Yeah.
By the way,
wait a minute. Over what period of time with the 41% beating their benchmark?
I'm getting to that this year.
Well, that's important.
This year, it says. This year. So a very
Oh.
short period of time, obviously.
Uh-huh.
Yeah. And guess where the money has been flowing?
I don't even have a clue.
Passive or index mutual funds.
Yeah. Oh, I thought you meant in terms of the active money.
No. I can almost guarantee you where that was flowing before Thursday and Friday.
Facebook and Twitter.
Yeah, I mean, it was all going into tech. And the FANG finally, bit down hard on the people that decided to do that. So,
not letting go.
I know, it's a tough
I'm
week.
the FANG stock.
Exactly.
Yeah. But you know what's funny is that S&P does a similar report every year called their SPIVA.
Yeah.
And they find that over 1 year, the highest number of active managers beat their benchmark, the highest percentage over 1 year.
Makes sense.
Then when you get out to 3 years, the percentage declines. When you get to 5, it shrinks even more. And when you get to 10 years, it's like 1 out of 10.
And remember here, you have to pick that one before, not after.
Right.
It doesn't
right.
help.
Yep. You're right. And there are other studies that have been done that show over and over again that the hot hand in a given period. In fact, DFA does this regularly, where they look at the best performing funds for a 5-year period, and for the next 5-year period, those best performing funds almost always end up either out of business or in the bottom half of the best performers. They end up underperforming in the following 5-year period. So even if you pick the ones who had won in the past, it doesn't. In fact, it means you probably will lose in the future.
So you can call us and tell us why you're a great stock picker, great trader, great day trader. We'd love to hear from you and talk all about that. But we can't find the track record for a long period of time. That's the issue.
And this AAII claim, it is so ludicrous.
You got to go back and tell them, because that sounds like another type of group.
The American Association of Individual Investors touts their incredible stock picking performance with what they call their shadow stock portfolio. Now, shadow stocks is a euphemism for teeny tiny, lightly traded stocks. Companies that may trade 100 shares a week are the shadow stocks.
Okay, really? That's what they're pitching? I didn't even know that.
Yes.
That's crazy.
Yes. So what they're saying is when we recommended this, from when we recommended it, it went up 2,800%. But because they moved the market themselves.
That's not very many shares, folks. And if you're a big organization, you tell everyone to go buy that stock, then guess what?
It goes up.
Yeah, that doesn't take a genius to figure that out. Wow, I didn't know that.
What if you're the last person to buy?
Somebody always is.
My mail was delayed.
Yeah,
I got this. Oh, it's already up 2,800%.
Yeah.
Well, go ahead and buy it anyway.
Short it now.
No. There's no trick to this. There is no trick. That's the fact. You need to understand that. You'll be a far happier investor. 855-935-TALK.
Tom and Don are talking real money.
Keeping the podcast breaks as painless as possible is my goal. That's why I want to very quickly tell you about the only magazine I've ever heard of that is 100% real investing all the time. There's no business news, no speculative advice, and certainly no lifestyle stuff. It's called Real Investing Journal. I publish it every quarter, and you can get 2 full years for only $25 at realinvestingjournal.com. That's realinvestingjournal.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And we're making bribes while the sun's shining. We're bribing people to call the show. That would be you. And if you'd like 2 years of Real Investing Journal, the only magazine devoted to real investing, for free, then call with a question about picking stocks, about building a portfolio, about retirement income, about people who may or may not be doing the right thing by you, about that junky annuity in your 403B plan, or whatever else it might be. 855-935-TALK is our number. That's 855-935-8255.
And we had someone call saying, I've got these annuities. Should I get out of them? Even though I think it may cost me something to do that. Well, we don't know.
They called off the air?
Yeah, we'd have to, kind of know what. In other words, if you just bought them last week, well, actually, I think you thought for 30 day, 45 days to rescind the contract, whatever it is. I don't know what the number is. But anyway, the point is, no, I think insurance contract. Anyway, so okay, let's just say you bought them a year ago, and they have an 8% surrender charge. Well, that's kind of tough. You may not want to turn around and hand them back and surrender 8% of your money. That said, oftentimes we run into people that have owned these for 6, 7, 8 years and are trying to decide if it makes sense to get out of them. This is something that you mentioned, Don, that I think makes sense in this case sometimes. That is, pay me now or pay me later. If you have an annuity that's costing you 3% a year, and you're just trying to decide if you should dump it and pay a 4% surrender to get your money back, and you can move it into something that's only costing 1%, then it probably does.
Half a percent.
Yeah, exactly. Probably does make sense then, right?
Yeah. Now the deal with annuities and is if you sign a contract outside of their place of business or something, then in a lot of states you have like a 30-day out, but in most cases annuities are like a 10-day. I don't know what it is in Washington. I'll have to look it up.
So you're
not 100% sure.
All right. Well, your bribe is working. So should we go to the phones? Oh, you want to mention the number?
Sure. Yeah.
Okay.
855-935-TALK.
Okay. Let's go back to the telephones. And Mike now joins us on Talking Real Money. Hi, Mike.
Hi. Good to hear from you.
Thank you.
I'm the proud owner of some stock. Not much stock, but I own stock.
In what?
And I have 4 shares in a local aerospace company.
A real big one?
It's a big company.
Yeah. Okay.
And it was a part of
I don't know who that is. I'm confused.
We'll have to think about that, but go ahead, Mike.
Yeah. Okay. And then the other stock, my mother's bank went corporate, so she bought an IPO for all of her
she's
children.
Got a few shares. Mm-hmm.
So it's not a bunch, but what I get in the mail at least once a year is a ballot, a voting ballot to retain officers, and almost every time there is a new compensation plan.
This is for the bank, not for the aerospace firm, I'm assuming.
Both of them. They both do it.
For the board of directors, probably, of XYZ Corporation.
Mm-hmm. Or for the officers.
Officers, pardon me. Yeah.
Yeah.
And I've taken the time to read the fine print once, and they're essentially saying, give us a raise or we'll go to Amazon or someone. So,
well, we all end up going to Amazon anyway, so it doesn't really matter there. But what is your question, sir?
Teach me about this because
a proxy vote?
About the vote.
Yeah.
And about the compensation plans because they're both competing against each other.
Yeah, I'm going to just stop you here because we have other people, and I hate to be rude, but the bottom line is individual shareholders can do very little to fight against compensation plans, nor those nominated to serve as officers or board members. Almost nothing that I know of.
Back in the day when I actually owned individual stocks, I always threw those away because the only people who have any clout are the institutional shareholders, like the big mutual funds.
Dimensional funds, they have 8% of the company.
Your vote on 10 shares is utterly, completely meaningless.
I hate to say that, but it's true.
Yeah, your vote doesn't count.
Yeah. It's a little like being a Republican in the state of Washington.
Unless you're in Bellevue.
Even there, it's smaller and smaller number.
Unless you're in Spokane.
I'm not picking on Republic. I'm just saying it doesn't matter a whole lot.
Unless you're at Lake Chelan.
Yeah, well, Okay, you know what? One more Chelan quote, and you're going to be voted. Normally, people get voted off the island. You're going to be voted off the lake.
Off the lake. I'm excited about seeing Chelan.
All right.
All right, who's next?
Steve is up next and joins us.
I lose track.
Hi, Steve.
Hi there. Hey, I have a question about charitable gift annuities. I just need to know what the positives and negatives are of those.
Wow.
The positives are getting somebody. It's a way to give money away. It's just another means by which, if you're going to be giving to charity, it's a way to start doing it now instead of later.
You said annuity in there, though, correct?
Yeah.
Yes.
It's those charitable.
You're going to be. So I mean, what's the? We know the product. What's the purpose?
Okay.
You're trying to give away money. Is that where we're headed here? I'm trying to understand why you want to know about these.
Or what you want to know about them.
We're giving away money out of our estate anyway when we pass away to charitable organizations. And, they promised that we would get monthly returns until we pass away. So it sounded like a win-win situation.
It is a win-win, but only in the case of someone who absolutely wants to see their principal go to a charity. Once you've set this thing up, you're not getting out. You'll get an income, but your money is going to that charity for sure. That's the downside, of course. The upside is you can continue to live off of those assets in the present day, and you get a tax write-off right away too, at least a partial tax deduction.
Yeah, and I don't know too much about the actual returns of those. I mean, because they're variable, right?
They're going to be low.
Yeah.
They're going to be on the low side. They're going to tell you they're going to be in the below 5 single digits in most cases. But that, again, if this money is absolutely earmarked for a charity, nothing wrong with it. Great way to get some income. So in that case, it is a win-win. Also, you get that deduction right now, which can be a partial deduction, which could be a big benefit.
Let's go to Eric quickly here on Talking Real Money. Hi, Eric.
Hello. My question, I'm about 5 years from retirement, and I have a 401k. I'm maxing out that. I'm contributing to a Roth IRA through a backdoor Roth.
Yep. Mm-hmm.
And I'm wondering, can I continue to put money in that Roth IRA after I retire?
You have to have earned income. Now you could recharacter. You could take the 401k money, move that into an IRA, and slowly move that to a Roth and pay the tax on it. Because
I still have to have earned income.
No, not to.
No, not to recharacterize.
Yeah,
he said you could take your 401k and year by year, little by little, put it in an IRA, and then recharacterize that IRA as a Roth IRA. But the only way you can contribute new money to a Roth IRA is if you have earned income. So if you semi-retire, have a part-time job, all the money from that part-time gig could go into the Roth up to the limit, but you have to have earned income to put money into a Roth IRA. Thanks for the call. 855-935-TALK is our number. 855-935-8255.
Tom and Don are talking real money.
I just recently created a new and massively improved interactive edition of Financial Physics on iBooks, but I don't want to leave out those without an Apple device, although no other platform offers their interactivity. I have, however, created a free static PDF version of Financial Physics with an F that you can get right now at TalkingRealMoney.com. That's TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
And don't forget, if you've got one of those Apple products, go get the free book, the iBook of Financial Physics in the iBook store or on the iBook store. And on the 18th of August, join Tom at a huge event, Retirement Roundtable at the Maidenbauer Center. You can get your tickets right now at TalkingRealMoney.com. That's TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.